Credit score. A credit score can be defined as a three-digit number between 300 and 900 that describes the credit merit of a credit card holder or of an individual who has taken a loan. In order to grant a loan in India, the potential lenders use the credit scores. Several lenders consider CIBIL score to be the benchmark for granting a loan to a borrower. Credit scores help to depict the credit and repayment history, utilization of credit, tenures of previous debts, and so on. Although the banks in India have their individual limit to grant loans, your chances of getting a loan approved is higher if your credit score is 900. A credit score is a representation of your credit worthiness in a numerical form. It is calculated by four credit bureaux in the country: TransUnion, CIBIL, Equifax, Experian, Credit Information Company, and Highmark Credit Information Service. Each credit bureau has its own proprietary algorithm they use to compute credit scores. They take into consideration several factors, including credit history, repayment behavior, among others, at the time of calculating the credit score. A credit score falls in the range of 300 to 900. If your credit score is closer to 900, you will have better chances of getting a good deal at the time of applying for a loan or a credit history. Majority of lenders like banks and non-banking finance companies consider a credit score of 750 and above as ideal. Credit score and how it is calculated. A credit score is a three-digit number that ranges from 300 to 900, as already said. It is calculated by the credit bureaus in the country. Generally, lenders like banks and non-banking finance companies, the NBFCs, consider a score of 750 and above as ideal. Each credit bureau uses its own algorithm to compute credit scores. It is calculated after taking into consideration factors such as payment history, credit utilization, credit age, and credit type. Let's take a look at all of these factors in with the level of impact they have on your credit history and score. Payment history. It has a high impact. Payment history is one of the most important factors that affects your score. If you have been consistent in paying your bills or loan or the EMIs, it suggests that you are a responsible borrower and are at a lower risk of defaulting. A responsible credit behavior will also make you eligible for preferential rates on loans and quicker approval on your applications. Making late payments, missing payments, etc. will lower your score by several points. Credit utilization ratio. It has a high impact. Credit usage is the second biggest factor that affects your credit score. The credit utilization ratio refers to the total amount of credit you have used in proportion to the cumulative total credit limit available to you. Credit utilization ratio is calculated by dividing your overall outstanding balance by your total credit limit. According to experts, consumers should ideally use only 30 to 40% of the credit limit to maintain a high score. Age of the credit. That has a medium impact. To better assess your credit worthiness, your history will credit is also considered while computing your score. If you have handled your credit in a responsible manner in the past and continue to service payments on time, your active credit lines, it will positively affect your credit score. A long credit history helps lenders take a sound decision on whether to offer you credit or not. Therefore, it is advised to keep credit cards with long history open compared to cards you have recently acquired. Total accounts have a low impact. It is important to maintain a good balance of secured as well as unsecured credit. A credit card is an example of unsecured credit, while a secured credit can be a car loan. A mixed credit helps to boost your score, although it has a lower impact. Here are 5 steps that can help you improve your credit score. First, clear all your credit card dues on time. Second, check your credit reports periodically. And third is keep your credit card utilization limit low. That is, keep your credit card utilization limit within 30%, as anything beyond this makes you look like you may be overextending yourself. Further, when your credit score is low, do not apply for a new loan, as it will make you appear credit hungry, which will bring down your credit score. Fourth, do not close your existing credit cards. Do not close your existing credit cards, as you may lose the available credit that came with the card, which may affect your credit score adversely. Keep on checking your debt to income ratio, which is the ratio of your income and debt. Fifth, do not make too many loan applications. If you applied for a loan or a credit card to one lender and it has been rejected, do not rush to another lender immediately. The new bank will see your credit score again and may reject the loan. The best thing to do is to wait for the credit score to improve before applying for a loan. Every time you apply, it's recorded in the report and it may adversely impact your credit score. Raising your credit score to a healthy level is a long drawn process, while clearing off your debts in a disciplined and timely manner may contribute towards a healthy credit score. It will not happen immediately. It will take at least 6 months to start showing a difference and can take as much as 2 years to get back to a good score. You should keep in mind that a credit score is built based on your credit history of many years, so try to maintain it throughout your life. That might have given you a fair idea about what a credit score is. And yes, do not forget to subscribe to the channel for future learning. Thank you.